Ladies and gentlemen, stop staring at the number on your screen. Whether silver says $79 or $89 does not matter anymore. That price is noise. It is the scoreboard, and right now the stadium itself is burning. The most important event of this week did not happen on a chart, in a trading app, or on a financial news headline. It happened in silence, behind closed doors, inside a classified emergency meeting that was never meant to be seen. While the market argued over technical levels, a leaked internal document confirmed a far more dangerous truth. The paper silver market has finally collided with physical reality, and reality is refusing delivery. On December 18th, one of the largest electronics manufacturers on Earth convened an emergency procurement meeting at its global headquarters. This was not routine. This was not precautionary. This was crisis management. The meeting brought together top executives, supply chain leadership, and factory heads responsible for keeping global production alive. The official topic was listed as critical material supply chain, but that language was a mask. The real question was brutally simple. What happens when the metal your entire business depends on no longer exists in deliverable form when you need it? This was not speculation. This was not market theory. This was an operational threat unfolding in real time. The company was not trying to speculate, corner a market, or make a financial bet. They were trying to secure a material required to manufacture products already sold to customers worldwide, commitments that cannot be canceled without destroying revenue, reputation, and trust. When their procurement team went through the official channels, the institutions designed to provide physical metal, they discovered something that shatters the foundation of this market. Availability is gone, not tight, not delayed, gone in scale. And if a corporation of this size with elite access and unlimited credit cannot secure what it needs, then price is no longer the story. This moment is where the illusion breaks. Everything that follows flows from this single failure. And once you understand what happened next, you will never look at the silver market the same way again. To understand why this meeting mattered, you have to understand what the company asked for and what it was actually offered. This is where the story stops being abstract and turns brutal. The procurement team did not ask for a year of silver. They did not ask for an aggressive stockpile. They asked for enough physical metal to cover upcoming production schedules with minimal safety buffer. Standard industrial practice, nothing extreme. The request was simple in structure and devastating in implication. 50 million ounces of physical silver delivered across the first 2 quarters of the year, not paper exposure, not cash settlement, physical metal that could be transported, verified, and fed directly into factories already running at full capacity. This request went to the largest and most trusted delivery hub in the silver market, the place that exists specifically to solve this problem. What came back was not a negotiation, it was a warning. The response offered just over 5 million ounces, barely 10% of what was required. No accelerated timeline, no hidden reserve, no alternative tranche waiting in the wings. That single number changed everything. Because this was not a pricing issue. Premiums were on the table, terms were flexible, delivery windows were open, the metal simply was not there. At that moment, the procurement team realized something most investors still refuse to accept. The delivery mechanism itself is failing. When an institution built to facilitate physical settlement cannot supply even a fraction of industrial demand, it is not a temporary shortage. It is a structural collapse. A system designed around paper promises colliding with the limits of physical inventory. This is where the illusion finally breaks. If a single manufacturer needs more silver than exists in registered vaults, then those vault numbers are no longer comforting statistics. They are countdown clocks. And this failure did not happen in isolation. It happened while other industrial giants were lining up, unknowingly competing for the same shrinking pool of metal. This is the moment the conversation inside that room shifted from procurement to survival. And once you see who else is competing for that silver, the scale of the problem becomes impossible to ignore. Once the scale of the shortfall became clear, the next question was unavoidable. If the official delivery system cannot meet this demand, who else is trying to pull from the same pool of silver at the same time? This is where the problem stops being about one company and becomes a systemic crisis. Because this manufacturer is not alone. They are simply early. Silver is not a luxury input. It is a critical industrial material embedded deep inside modern technology. Electric vehicles, energy storage, solar panels, data centers, and advanced electronics all consume it in ways that cannot be easily substituted. And every one of those industries is expanding at the same time. That means demand is not cyclical. It is structural and accelerating. Other major industrial buyers are drawing from the same limited inventory. Automotive manufacturers require silver for power electronics and battery management systems. Solar producers depend on it for conductive pastes that make panels viable at scale. Semiconductor and AI hardware companies use silver in bonding wires, thermal interfaces, and high-reliability connections. Each sector alone would strain supply. Together, they overwhelm it. When you stack these demands side by side, the math becomes unforgiving. Documented industrial requirements from a handful of companies already exceed total registered inventory by multiples. And registered inventory is not spare metal. It is already pledged, already counted on, already promised to someone else. There is no excess waiting to be released when the price rises. This is why the offer of 5 million ounces was not stingy. It was proportional, allocated, carefully rationed to avoid triggering a visible failure. The system is attempting to spread scarcity thin enough to delay panic. But scarcity does not disappear when you divide it. It compounds. At this stage, price becomes almost irrelevant to buyers who need physical delivery. The cost of not having silver is infinitely higher than paying a premium. Factories do not shut down gracefully. They collapse, revenue destroy contracts, and ripple through entire supply chains. That reality turns industrial demand into something most investors underestimate. Completely inelastic. This is why competition for physical silver is no longer financial. It is operational. And when operational buyers enter panic mode, they do not stop at technical resistance levels. They stop when the metal runs out. At this point, a reasonable question emerges. If demand is this extreme, why hasn't the market already adjusted? Why hasn't supply rushed in to meet it? The answer lies in a quiet but decisive shift that took place far from trading floors and factory gates. A policy change that turned a tight market into a choke point almost overnight. On January 1st, new export licensing rules take effect in the world's most important silver refining hub. For decades, global manufacturers relied on this region to turn raw ore into usable industrial metal. Even silver mined in the Americas or Australia often passed through these refineries before reaching Western factories. That pipeline is now closing. Under the new system, only refiners meeting strict production and credit thresholds are allowed to export. On paper, the rules look administrative. In practice, they function as a filter that eliminates hundreds of smaller and mid-sized suppliers overnight. The result is not less silver being refined, but less silver leaving the country. For manufacturers outside the system, the impact is immediate. Long-standing supplier relationships become irrelevant. Contracts are honored in name only. Volumes shrink. Timelines disappear. What once flowed steadily into global supply chains is suddenly redirected inward, prioritizing domestic industries and strategic partners. This forces Western buyers into the same shrinking pool of deliverable metal. Vaults that already struggled to meet demand now face a surge of buyers replacing lost supply. The effect is compounding pressure, not relief. Every ounce that fails to leave the refining system must be replaced elsewhere, and there is nowhere else with sufficient scale. This is not a trade dispute. It is resource control. By tightening export channels at the refining stage, leverage is applied without headlines or sanctions. The market experiences it not as politics, but as disappearance. Orders that used to clear no longer do. Metal that used to arrive simply doesn't. This is the catalyst that transformed a difficult procurement challenge into an emergency. And it is the reason the scramble intensified precisely when it did. The clock started ticking the moment that supply route narrowed, and it does not stop on its own. With primary supply routes failing, the procurement team did what any rational organization would do under pressure. They moved laterally. Every alternative channel was tested at once, not to optimize cost, but to find volume. What they found was not resilience. It was exhaustion. Major bullion dealers were contacted first. The response was immediate and unsettling. Large orders were quietly suspended. Quoted delivery windows stretched far beyond production timelines, often without guarantees. Volumes were measured in hundreds of thousands of ounces, not millions. Premiums climbed sharply, but price no longer functioned as a lever. Paying more did not unlock metal that simply was not available. Mining companies offered little relief. The reality is that most global silver production is already committed through long-term contracts signed years earlier. Those contracts cannot be unwound quickly, and new production cannot be accelerated on demand. What remains uncontracted is small, fragmented, and fiercely contested by multiple industrial buyers facing the same crisis. Financial solutions failed next. Leasing arrangements, once a low-cost bridge, now carry rates high enough to introduce significant risk. Banks already exposed are unwilling to guarantee renewals or long-term availability. Exchange-traded products reveal delays and structural limits with increasing portions of metal unallocated rather than physically deliverable. When these options are combined, the conclusion becomes unavoidable. Even under optimistic assumptions, total obtainable silver falls far short of what is required. The gap is not a rounding error. It is large enough to force decisions that no manufacturer wants to make. This is the moment procurement becomes triage. What gets produced, what gets delayed, and what gets cut entirely. These decisions are happening quietly behind the scenes, but their consequences will not stay there for long. As these internal assessments came together, a second crisis emerged, one that reaches far beyond manufacturing. The silver shortage is now pressing directly into the financial system that supports the market. This is where an industrial constraint becomes systemic risk. For decades, bullion banks operated on a simple assumption. Physical metal would be available when needed. Paper contracts could be issued freely because delivery was treated as a technicality, not a threat. That assumption is failing. As industrial buyers demand, physical settlement banks are exposed in ways their models never anticipated. Rising prices create immediate stress on short positions. Margin calls arrive fast and without warning. Liquidity must be raised instantly to prevent defaults. Recent emergency interventions were not precautionary. They were reactions to pressure already present inside the system. The dynamic is self-reinforcing. Higher silver prices increase losses on paper exposure. Those losses force liquidity injections. Additional liquidity weakens currency value, pushing hard assets higher and worsening the original imbalance. Each attempt to stabilize conditions intensifies the problem it seeks to contain. There is no clean exit. Allowing failures would trigger a violent repricing. Preventing them requires continued intervention. Neither outcome restores physical supply. Both acknowledge that paper claims exceed available metal. As delivery deadlines approach, emergency measures appear. Higher margins, position limits, forced liquidations. These are not solutions, they are time-buying mechanisms, and time is the one resource the system no longer has. At this stage, the crisis takes on a geopolitical dimension that most market participants underestimate. Silver is no longer just a commodity constrained by supply and demand. It has become a lever of power, and the countries that control refining capacity understand this far better than those who trade futures contracts. By tightening control at the refining stage, supply is not destroyed. It is redirected. Metal that once flowed freely into global markets is now prioritized for domestic industries and strategic partners. This forces foreign manufacturers into an impossible choice: compete for shrinking Western inventories or reposition production closer to the source. This is how resource control functions in the modern era, not through embargoes or public confrontation, but through licensing, compliance, and quiet administrative barriers. The effect is invisible until it is irreversible. Factories do not stop because of policy announcements. They stop because shipments do not arrive. For manufacturers that invested heavily in reshoring production, this pressure is especially severe. Facilities built to reduce dependence now face a single point of failure. Without access to refined silver, even the most advanced factories cannot operate. Capital investment becomes stranded not by economics, but by material access. Behind the scenes, strategic discussions begin. Joint ventures, local partnerships, production shifts framed as efficiency decisions rather than necessity. Resource access becomes the unspoken condition. This is not speculation. It is how industrial supply chains adapt under pressure. What makes this dynamic especially dangerous is its asymmetry. One side controls refinement and allocation, the other relies on financial markets and paper instruments to bridge gaps. When those instruments fail, leverage concentrates quickly. This is no longer a market imbalance. It is a strategic contest unfolding quietly, ounce by ounce, contract by contract. And the longer it persists, the more manufacturing gravity shifts toward the point of control. As pressure builds across industry finance and geopolitics, market behavior begins to change in ways that feel sudden but are entirely logical. This is the phase where caution turns into hoarding. Not retail speculation, but industrial self-defense. And once that shift occurs, the system accelerates rapidly. Large manufacturers monitor the same signals: inventory drawdowns, delivery delays, policy constraints. None can afford to be the last buyer, so procurement strategies evolve. Orders are no longer sized to immediate needs but to future uncertainty. Safety buffers expand. What starts as a manageable shortage becomes a race for coverage. This behavior is not emotional, it is arithmetic. The cost of paying a higher premium is finite. The cost of missing production is open-ended. Lost output triggers contractual penalties, revenue gaps, and reputational damage that far exceed the price of metal. In that equation, overpaying becomes the rational choice. As this unfolds, quoted prices lose relevance. Spot markets reflect paper trades, not physical urgency. Real transactions occur quietly at off-screen premiums. The divergence between paper silver and deliverable silver widens, confusing those still anchored to charts. This is also when retail access begins to degrade. Order limits appear, delivery timelines stretch, availability thins, not because demand fades, but because supply is being absorbed upstream by buyers who cannot wait. Once industrial hoarding begins, it rarely reverses quickly. Scarcity feeds urgency. Urgency drains inventory. And the market shifts from debating price levels to confronting a simpler question: who still has metal left to sell? By the time the shortage becomes visible to the public, the outcome is already largely decided. Markets do not break when headlines appear. They break when insiders quietly change behavior weeks earlier. This is the phase where confirmation arrives too late for most participants. As delivery deadlines approach, exchanges and clearing institutions are forced to react. Emergency measures begin to surface. Margin requirements rise sharply. Position limits tighten. Incentives are offered to settle those contracts in cash rather than metal. These actions are framed as risk management, but in reality they are containment strategies designed to ration scarcity. What matters is not the rule changes themselves, but why they are necessary. A market that can deliver does not need to discourage delivery. A vault that is full does not need to buy time. These measures are signals, not solutions. They acknowledge that obligations exceed inventory. At the same time, industrial buyers face a narrowing window. Production schedules do not wait for policy adjustments. Contracts must be honored or renegotiated. Guidance must be issued. The pressure shifts from sourcing to messaging, from procurement to damage control. This is when shortages go mainstream. Production delays surface across multiple sectors. Analysts scramble to revise forecasts. Media narratives shift from growth to disruption. Retail buyers discover that access has changed, not gradually, but all at once. The final irony is that price spikes do not create supply in this phase. They only reveal it is gone. Metal does not appear because charts break out. It appears only if it was already there. And by the time the breakout is obvious, that inventory has usually been claimed. This is how the transition completes. From quiet warnings to visible stress, from private concern to public realization. And once the system reaches this stage, outcomes become binary rather than probabilistic. This is where the analysis stops being academic and becomes personal. Because when supply chains fracture at this level, waiting for perfect confirmation is no longer a strategy. It is a decision. The events you have just followed are not hypothetical scenarios. They are signals from inside the system surfacing before the headlines arrive. The central lesson is simple but uncomfortable. Markets do not ration scarcity through price at first. They ration it through access. By the time prices fully reflect reality, availability is already gone. That is why focusing solely on charts misses the bigger picture. Price moves last. Behavior moves first. Industrial buyers understand this. They are not asking whether silver is cheap or expensive. They are asking whether it exists when needed. When that question becomes uncertain, premiums stop mattering. Contracts get rewritten, production plans change, and capital flows toward certainty, not bargains. For individual investors and observers, the takeaway is not panic. It is clarity. This is a reminder that real assets behave differently when systems are stressed. Paper claims depend on trust and liquidity. Physical assets depend on inventory and logistics. When those two realities diverge, the rules change. The strategic response is not to chase headlines, but to position. Before access narrows further, that applies to capital, to expectations, and to risk management. History shows that shortages do not resolve smoothly.